all. Good afternoon. If that's the case, it's a delight to welcome you to our uh, webinar this morning on fiscal challenges in the post-pandemic period. It is a sister or brother webinar to one held yesterday evening on global monetary conditions. So this one looks more particularly at questions as diverse as how much debt is too much. What about what are we thinking in terms of exiting from massive fiscal stimulus packages? And in all of that, we want to look at general conditions around the globe, but also we'd like to bring it to bear on a particular emerging market. And in this year's series, we're looking particularly at Brazil. So I'm Tom Trebot. I'm the director of Columbia's Global Center in Rio de Janeiro in Brazil. So I'm very pleased to be one of the organizers of this series. Without more from me now, you'll be hearing from me a little bit later. I'd like to turn the webinar over to my good colleague and partner in organizing this series on the changing role of the state, Brazil, and global perspective. I'd like to turn it over to him, to Professor Jan Svenjar of CEPA. Good morning, Jan.
Thank you, Tom. Good morning. Good morning to everyone. Let me welcome you on behalf of the series and also on behalf of the Center on Global Economic Governance, which I direct at Columbia. It's been a pleasure to actually do this series on the role of state in economic growth and development for the last several years. The partnership with the Columbia Center, Rio de Janeiro, has been tremendous, and today is the latest of the panels that we're holding together. Obviously, it's a very, very special period in terms of the pandemics, but also what we'll be talking about today, namely the fiscal issues. The governments have obviously taken on, many of them, a very strong fiscal stand in the period since last year. And so it's important to have a look at what has happened and what is likely to happen, what are likely to be the consequences. We have three terrific panelists with us today. Let me introduce them very briefly, and then I'll let them proceed. The first one is Danny Leipziger, who is Professor of International Business and International Affairs at George Washington University. He's also Managing Director of the Growth Dialogue, a group of leading experts all around the world examining issues of economic growth. Formerly, he was the Vice President of the Poverty Reduction and Economic Management Network, so-called PREM network, between 2004 and 2009. And he has been focusing on macroeconomic issues, financial markets, developing countries, international monetary issues. He's held management positions at the World Bank in East Asia, Latin America, Caribbean region. He also was at the World Bank Institute. And prior to joining the World Bank, he worked in senior positions at the US Agency for International Development and US Department of State, holds PhD in economics from Brown University, and has published very widely in a number of areas ranging from development economics, finance, industrial policy, banking, and has books on Korea, East Asia, economic growth, globalization, and inequality. I could go on, but let me move on to our second speaker, Ana Carla Abrao Costa. Ana Carla is a partner in the finance and risk and public policy practices and is head of Oliver Wyman in Brazil. And she's focusing on topics related to risk control, credit modeling, banking spreads, banking regulation, compliance, and retail. She has a career in the public sector as well, where she has focused on taxation, efficiency of public management and public policy. She holds her PhD in economics from the University of Sao Paulo and was also a senior economist at the Central Bank of Brazil. Did important work in the research department, developed new methodology of decomposition and measurement of banking spreads in Brazil, and led projects for the Brazilian Central Bank, Banking Association, banks and financial sector infrastructure entities, and supported federal and subnational governments in fiscal and management strategic topics. Last but not least, coming back is Tom Trebot, who introduced this morning all of us here, and he is director of the Columbia Global Centers in Rio de Janeiro. It's one of the most important centers that we have around the world, He joined Columbia after a long career on Wall Street. He was dedicated to research on Latin America, formerly served as executive director of the Institute of Latin American Studies at Columbia, an important institute we have, and also the Institute's Center for Brazilian Studies that focuses specifically on Brazil, has experts from Columbia and also visitors, important visitors. Okay? Tom was managing head of the Latin American team in the Economic and Market Analysis Department of Citigroup. He worked also in Bankers Trust, the Ford Foundation, and Chemical Bank. His PhD is in economics from Vanderbilt University, and he's been very active in teaching, research, and management at Columbia. So we have a terrific lineup. I'll be the moderator, but basically the people who moderate themselves. We'll have introductory remarks from each of the panelists, and then we'll have a question and answer period, which I will moderate myself. So let me, without much ado, invite Danny Leipziger to get us started. Danny, welcome, and the floor is yours.
Well, thank you. Thank you, Tom and Jan, for the invitation. I'm happy to join. In my 15 minutes, I'm going to try to cover three topics. One is the bigger picture on the fiscal situation globally. Second, a few observations on Brazil. And then third, a little bit of the post-pandemic outlook in terms of fiscal matters. So I think it's important to note that in fighting the pandemic, all countries have pulled out all the stops. And on average, the advanced economies have put in stimulus packages equal to 15% of GDP. Middle-income countries, roughly 10% of GDP, and low-income countries, about 5% of GDP, obviously because they have greater difficulty of financing these expenditures. So this total of 14 trillion in stimulus, combined with some reduction in revenue collection, which comes anytime you have a recession, and certainly this one is a major recession, has widened the fiscal gaps around the world. For advanced economies, this is less of a problem because they can finance themselves. The US being the easiest because of its exorbitant privilege, as Barry Eichengreen used to refer to the role of the dollar. But the IMF has given us a pretty sobering outlook, which is that for 110 countries in the world, we don't expect their GDP to get back to their 2019 level until 2023. So we're talking about 3 or 4 years of lost growth in a lot of emerging markets and developing countries. The whole reaction to the pandemic is straight out of Macro 101, which is, consumption has dropped everywhere. Investment has dropped because of lockdowns and low expectations and greater uncertainty. Exports as well, although less severe than consumption. So the only piece of aggregate demand that, that can counteract this huge slowdown, which is produced negative growth rates in 2020 around the world, is government spending, right? And that's where governments have done this. The big issue, as I mentioned, is how do you finance it, right? So if you are a developing country, basically you have 2 or 3 possibilities. One, you can print money. Most developing countries have realized that inflation is not a good thing, and so most of them have resisted that. The second is that you could increase taxes, hard to do. You could tap your local capital markets, hard to do because they're not very deep. You could borrow from multilateral organizations, and the fund and the bank have provided, the World Bank have provided a lot of new loans, or you can borrow. And if you borrow at even low interest rates, it seems attractive. However, you have to repay. You have to repay in foreign exchange, and the likelihood of your exchange rate improving in the next couple of years is not very high. In fact, emerging markets have seen a reduction in the value of their exchange rates over the last 5 years or so. On top of which, even before the pandemic, the debt the GDP ratio for emerging markets and developing countries was, according to the World Bank, 260% of GDP. So countries were overly indebted. It was a pre-existing condition prior to the pandemic because we'd had low interest rates for many years. So that's sort of the one side of the story. The other side is that the IMF and the World Bank countries, you have to do what you need to do, right? Kristalina at the IMF has said, you know, you have to spend and just keep the receipts, which is a comment on good governance and where the money goes, which I'll come to in a minute. And Carmen Reinhart, who with Rogoff has written the most extensive work on the history of financial crises, now chief economist at the World Bank, has said, first you fight the war and then you pay for it. So these are admonitions that we would not normally have expected to hear from either the World Bank or the IMF. And it means that countries are going to have to be quite cognizant of the fact that they're going to face more debt difficulties in the next few years. There's a repayment bulge in any case. But coming back to the fiscal side, I think what's important is not only that you spend the money, but that you spend it wisely and that you target those that really need the support. Many emerging markets have been pretty profligate, I would say, in terms of public spending. We have studies all over sub-Saharan Africa that show that 2 to 3% of the GDP is lost every year just in the education sector. And this is due to absentee teachers. We're not even talking about learning versus being in school. So there's a lot that needs to be done to improve public spending. Public investment is an area that needs attention. I'm a big fan of the work of Joseph Peckman in the 50s, which looked at Brookings at the expenditure incidence of public spending, as well as the tax incidence. I think we really need to know where the money is being spent. Okay, let me move to the second topic, which is Brazil. I do this with some trepidation, since most of you know Brazil better than I. But I will say that my wife and I have an apartment in Sao Paulo, and we visit Brazil a lot, and we work in Brazil, so we feel like we can say a few things. So there's been good news that I'm sure Ana Carla will refer to, having to do with some of the legislation that's occurred, this teto de gasto, which puts some limits on current account expenditure. But I think it's worth noting that something on the order of 90% of expenditures are non-discretionary, right? If you take debt service, which is about 20% of spending, and you add to it things that are mandatory, there's not a lot of room when you have to cut. And if you're in a position where you're increasing spending, which is what Brazil and other countries have been doing, it's going to be difficult to reverse. So the World Bank and other experts that look at the fiscal story in Brazil point to certain incentives, particularly those given to the business sector, as areas where you could save maybe up to 5% of GDP. I don't have a view on this, but I have a different view, which is that one of the big areas where fiscal policy could make inroads, in addition to pension reform, which is being worked on by Minister Guedes and others, has to do with BNDES, which is the state bank, which lends much more than the World Bank. It's a huge bank. Many analysts of BNDES say that it lends to the wrong companies for the wrong reasons and at the wrong price, right? So I would like to focus a little bit on the price, because in the past it's been noted that the lending rates from BNDES were half of what it cost the Brazilian treasury to borrow, right? May not be true today because rates are down, but there's a huge subsidy involved. And this also comes from the workers' pension plan, the FATS, and other sources. We could have an interesting debate about industrial policy, but that's not the issue. The issue is that huge amounts of fiscal resources are going into this bank, and it's not clear that Brazil is getting much return for that. The other thing about Brazil is that people always look at the numerator in debt to GDP ratios, right? Debt is rising. In the case of Brazil, less of it is external, so that's the good news. More of it's internal. That's not such good news because it crowds out other expenditures, and it distorts the capital market towards government paper. But the main issue is that we should look at the denominator. We should look at growth. What is limiting growth in Brazil, which has been below expectations now for almost a decade? And people point to things that are very well levels of infrastructure spending. Public spending in infrastructure is quite low. I used to run an infrastructure and finance department for Latin America, and at the time, Brazil was spending 2% of GDP on infrastructure, and hoping that the private sector, in terms of PPPs or other private participations, would fill the gap. But in reality, public and private investment in infrastructure are complementary. They're not substitutes. If the government doesn't do its share, it's not going to attract much foreign investment. So between that and red tape, I said I owned an apartment. I can tell you red tape is a big issue. And issues of competition. There are impediments to growth that Brazilian economists know quite well, and that would help in looking at the debt to GDP ratio and the debt to GDP relationship, because you have to generate more economic growth in order to repay some of your debts. I know there's a golden rule for capital projects. Perhaps we can get into that in the Q&A, but those would be my two messages on Brazil. One, look at BNDES much more seriously. And the second is look at the impediments to growth. Let me turn now to the third topic, which is the post-pandemic outlook. We know that the outlook is highly uncertain. All the uncertainty indices tell us that we are in a world of uncertainty. And in uncertainty, we're going to experience a lot of stress on budgets, right? And it's time, therefore, to look at unproductive programs and move resources from those areas that are not yielding the return to those that are. We also have global liquidity glut, I would say, which we've had for since 2010. And the question is, how do you move money into productive investments, particularly in emerging markets, when interest rates at home are quite low? And this means that countries have to make themselves more attractive. And we can go into surveys like the World Economic Forum's competitiveness survey or the Doing Business report of the World Bank. And Brazil knows where it stands in many of these areas, but it's true for all countries. It's a competitive environment. We know that global value chains have shifted, disruptive technologies have taken over, and trade is not booming as it once was. So attracting the right type of FDI and being strategic about it is one way to relieve some of the future fiscal burdens. I want to end on two controversial topics, which we could talk about in the Q&A. They both have to do with a well-known economist named Olivier Blanchard, who was at MIT and then the chief economist at the IMF and now at Peterson. One important observation by Blanchard, who's also the president of the American Economic Association, is that countries should be less worried about debt if interest rates remain low and if their growth rate can exceed the rate of interest, because in that case, neither the debt to GDP ratio will rise, nor will it be hard to roll over the debt. So Blanchard, I think, gave some good advice to countries when they should be in a position to borrow. Of course, it depends what the rate of return is on that borrowing. What are they borrowing for? Is it for consumption? Is it for investment? Who's getting it? What's the rate of return? Is there corruption, etc.? But more recently, there's been a debate in the US on the size of the US stimulus package, and various well-known economists have come in on different sides of the issue. Larry Summers saying it's the 1.9 billion package is too big, trillion package is too big. Krugman saying it's fine. Stiglitz saying it's fine. And Blanchard coming out pretty much on the summer side of the equation, saying if you look at the output gap in the US, which is a construct that is difficult to do with any precision. The output gap is based on your potential output of a country, which means that you have to do a lot of heroic assuming in order to get to this output gap. And it's also a function of what the multiplier is, how much people are going to spend. And we know from past recessions that people don't spend in accordance with historical numbers. And so therefore, using historical multipliers is perhaps not the best idea. So these things are relevant for fiscal positioning, right? The IMF always says you should create fiscal space. And the pandemic obviously has chewed up a lot of fiscal space. The question is, how much borrowing should occur? How much stimulus is needed in various countries? And most importantly, how is it going to be financed? And I think for finance ministers around the world, how is it going to be financed is the big question. It's not so much should we do fiscal stimulus, it's how do we finance it? And I would say it's also how you target it, and it's also what the return is on those expenditures. So I think these are some of the issues that we have to look at in the post-pandemic world. Thank you. Yeah.
Thank you very much, Danny. And I think both the global points and the one specific to Brazil are very important. We'll return to both. Let me invite Ana Carla now to give us the view from and on Brazil. Thank you.
Sure. Thanks, Jan. Hello, everybody. Hello, Tom, Danny, and the audience. And of course, thanks, Danny, for the words about Brazil. And I really think that my words here will be complementary to what you just mentioned. The only point that I would like to make before starting my points is related to BNDES. Actually, there was a reform passed in 2018 that changed the interest rate of loans of BNDES. So now the subsidy is much lower. And with interest rates coming down, this almost disappeared. So this is a very important point that you made, but I think this one, we have been able to solve it some years ago, actually a couple of years ago. So I think it's worth mentioning because at least this one we improved. But all the points that you made were very precise, and I agree with all of them, especially the impediments to growth, that we must look at this and be able to recover the economy and be able to grow again. And that's why I really think my words will be complementary to what you just said. Well, having said that, thanks for the invitation. It's a pleasure to be here, participating with my colleagues and of course sharing some thoughts. It is a pleasure, and of course I recall my last interaction that was around 2.5 years ago, when everything was quite different and perspectives brighter than they unfortunately are today, at least for Brazil. At that time, we were more optimistic, discussing the importance of a comprehensive state reform and its expected impacts for Brazil. No one could ever imagine the changes we would go through and the challenges we would face in the then near future. So there are many types of challenges that we have to face now. And that's why we are now. And I must say, it's not an easy task to talk about my country nowadays. Not only we have been shaken by the pandemic and are now facing a severe second wave of contamination, but also because both economic and fiscal situations in Brazil have considerably deteriorated during those last 2.5 years. After an expected drop of around 5% in last year's GDP, following, we must remember, a very shy recovery from a deep recession that took place in the period of 2014 and 16 and made us all Brazilian at least 10% poorer. Most optimistic estimates now reach out to around 3% growth for 2021, which is not enough to get us back to 2013. So it's not at all an easy scenario ahead of us. On the fiscal side, the numbers are also not at all bright. Although as Danny just mentioned, we are not alone in this point, but we may be indeed alone in terms of the ways to put the fiscal path back on track. Reforms have been formulated along the last 2, 3, 4 years. They have been presented to Congress, and they, of course, were halted with the pandemic. And of course, the necessary fiscal stimulus that we went through, particularly the direct transfers to the poor population, they led us to a big deficit and busted the debt to GDP ratio that is now over 89%, which is pretty high for Brazil. That same ratio was previously to the pandemic, and thanks to a successful social pension reform that Danny just mentioned, following a more sustainable path, but this is all gone. Currently, estimates from the IFI is an independent fiscal institution that oversees Brazilian fiscal numbers on behalf of the Senate. Those numbers show that only in 2030 we will be able to stabilize the debt to GDP ratio in Brazil, and at a very high level, above the 100%. But I don't want to scare you too much with this pessimism. So let me talk about the reforms that the government and the Congress are now signaling that they will make an effort to approve. And this may give us some hope that Brazil will be back to a more benign growth and fiscal trajectory sometime in the future. There are 3 main reforms that I would point out here, and they are under discussion. There are 3 constitutional amendments, and as such, will only pass in Congress if approved by a qualified majority. 2/3 of the Congress has to be in favor. So this is an effort that depends mainly on government political ability and support. The first one is the so-called emergency amendment. It was presented to Congress before the pandemic in November 2019, and originally the emergency at that time was related to fiscal and not to the upcoming health emergency. It relied on a set of fiscal responsibility measures, very important ones, that would allow cuts of public spending that, as once again Danny just mentioned, are very rigid in Brazil. So we would be able to have more flexibility in public spending and consequently more room to cut. And this was related also to what we call the fiscal emergency situation, where the entity, federal, state or municipal government, reaches 95% of its revenues, costs of 95% of its revenues. And those mechanisms would be freeze of civil services payroll, reassessment of tax incentives, to increase tax revenues, measures that could at least cope with the fragile fiscal situation, especially of subnationals. But this amendment, this proposal was kept aside for more than 1 year. And now currently a new emergency amendment proposition is under discussion in Congress. It relates more to additional and necessary extension of money transfers to the poor than to the cutting of public spending to make room for it. There are indeed some indications of where this could be done, but it is far from being a consensus. And what we see is that there's little chances of approval the way it was presented. We might see the approval of the extension of the public rescue for individuals, but it's very unlikely that the fiscal compensations will go along with it, considering the sensibility of the measures proposed, particularly the ones that are related to education and health expenditures, and also, of course, the ones linked to civil services salaries that have a stronger influence in Congress in Brazil. The second reform, the second amendment, is the Brazilian tax reform. This has been under discussion for ages in Brazil. And the point is that Brazil has one of the most complex tax regimes in the world. Besides that, it's tremendously regressive, with the tax burden to the poor being heavier than to the rich people. A complete reform is under discussion, as I mentioned, for at least 3, 4, 5 years, and would merge federal, state, and municipal taxes under a centralized VAT. That's the core of the reform. It's not an easy discussion, considering the natural and understandable federative conflicts, and it will take more time, as additional rounds of discussions are still to be seen to build consensus. It is also linked to a federal fund to compensate states for the reform and eventually for losses in their revenues. And in the current fiscal situation, this is quite difficult to see. But at least a small part of it, the unification of federal taxes, is expected to pass this year. Let's see. It's not a game changer, but at least it's a first movement towards future major reform that we hopefully might see in the future. Last but not least, the civil service reform is the third constitutional amendment under discussion. Actually, this discussion is currently starting in Congress. The amendment was presented, the draft was presented last year by the federal government, by the president. And in my opinion, this is the most important structural reform for Brazil. When we talk about impediments for growth, when we talk about red tape, this is all related, but mostly when we talk about inequality, this is really a very important reform. But I see 3 reasons for that. First of all, we utterly need to improve basic public services in Brazil. Brazil is one of the most unequal countries in the world. Brazil needs to offer better public education, better public health services, better security to its citizens, but especially for the great majority of the population that has no way of accessing those services other than through the state. Without a complete redesign of the public sector operational model, this won't be possible. We need to be able to set better and more flexible selection processes, which doesn't mean abandoning the neutral or the fairness of the selection, of course. We have to implement an individual and collective performance evaluation model for public employees and link their salaries to the results. We need to be able to fire low performance employees and invest in training and building new competencies. This is only possible with the new operating model because the current one is rigid, it's outdated, and it's extremely costly. The second reason for a state reform or civil service reform is productivity. Productivity is stagnated in Brazil for the last 25 years. Actually, it has effectively decreased during the more recent years. There is no chance we succeed in improving productivity in Brazil without improving the productivity of the public sector in Brazil. Public sector in Brazil accounts for more than half of the Brazilian economy. So it's impossible to raise productivity in Brazil if we just disconsider the productivity of the public sector. So only with a comprehensive civil service reform, once again, will Brazil be able to improve the low, if not negative, productivity of the public sector. And then the third reason is indeed fiscal. Civil servant salaries account for the equivalent of 13% of the Brazilian GDP and counting. This is much higher than our peers and far above what we see in developed countries. This is the third main public budget expenditure, just after pension deficit, even after the pension reform, and public debt financing. It's really necessary that we have a more rational, focused, and efficient regime to reallocate the public expenses to control the accelerated payroll expenditures growth in the public sector in Brazil, which, by the way, has not been followed by improvements in the quality of public services. But this last piece, the draft that is being discussed in Congress, it's a very complex and fragmented reform. And I believe it will take some time to mature. Together with the former central bank governor, Arminio Fraga, and Carlos Ari Sundfeld, a very prestigious Brazilian lawyer, I have proposed a more simple and straightforward reform. But the government decided for a more aggressive, although more long-term oriented one. The good news is that at least we have something to build on. The discussion has started. The bad news is that it faces a good chunk of resistance in Congress due to civil service unions lobby. So we will have some challenge ahead of us, but at least the game has started. So bottom line, Brazil does have a fiscal problem on top of the health emergency that came through with the pandemic, but not at all entirely linked to it. We know what we need to do to solve it, or at least to make this problem solvable in the future. But this means facing structural reforms that, unfortunately, the current government has not shown, at least up to now, political will or political strength to pursue. This means that we will have to cope with volatility, with instability, and low growth for some time, up to the point where Congress takes the lead or a new government replaces the current one in 2 years' time. Well, I'll stop here to make sure we have time for the debate and to deep dive on those and other points that my panel colleagues in the audience might be interested on. Thank you very much.
Thank you, Ana Carla. It's been a fascinating account and indeed lots of food for thought, complementing what Danny said. So let me invite Tom now to give us the third view on the world and Brazil, and then we'll open it up for a discussion.
You know, they say, yeah, three economists, 4 points of view. I mean, that's this, I think what we'll experiment with a little bit here. I just want to thank Ana Carla and Danny for their great introductory remarks. I've got a difficult level of trying to be a mezzanine approach, a little less global than Danny and a little less into Brazil than Ana Carla. So I'm not probably going to hit either theme exactly right, but I did want to start out with just quick reactions to Danny, what Danny has told us. And I think, Danny, there's a lot of concern in Brazil and the rest of the world about inflationary impacts of the US spending, how much spending before we're really going to have an inflationary burst in the United States, which would have implications for the rest of the world. So that's one maybe issue that we could come back to, John, in the discussion.
Yes, indeed.
And Ana Carla, you've touched upon it at the end. I wasn't sure how you're going to deal with it, but Brazil is really the political economy of reforms in Brazil and the upcoming 2022 elections. You describe a situation where they ask there are these reforms going through, but they're bound and determined to get mixed up with Brazilian politics. And you don't sound terribly optimistic about that much of significance happening between now and 2022. So a question for you might be the currents of thought, the different schools of thought about how Brazilian fiscal policy needs to be recast and whether those elections might really be a a point for Brazil to start over. So I just maybe start with those kind of questions in response to my colleagues who have preceded me. But let me then just go into my more general remarks about Brazil, putting Brazil in a more general context that Danny has suggested. The first is, and it seems painfully obvious, but how would a different world we're in than anybody ever thought or imagined? You know, we'd stop to think about it. Danny mentioned the figure of $14 trillion in global fiscal support to mitigate the effects of the pandemic on consumption and output, and the huge the contraction in public sector revenues and the consequent rise in public sector debt and deficits. And yet it isn't provoking the angst and concern that otherwise those kinds of numbers would provoke. So we're really in really uncharted waters. Global debt, Danny reminds us, reaches about 98% of GDP. He mentioned Carmen Reinhardt's work with Kenneth Rogoff, suggesting that 100% of GDP, at least for the emerging economies, not for the advanced economies perhaps, was sort of like a death sentence. This is bound to lead to fiscal instability, to debt servicing difficulties, to recessions, to that whole spiraling downward of domestic economies confronted with fiscal instabilities. So we're at 98%. In Brazil, Ana Carla reminds us that that ratio reached 89% by the central bank's numbers last year, 95% by the fund's numbers. So you'll hear different numbers, but the magnitude of the order of magnitude is the same. And the increase is astonishing. 15% of GDP increase in the debt to GDP ratio in Brazil in just 1 year is extraordinary. And yet it hasn't provoked a kind of a national catharsis yet. It hasn't, we are still discussing how to support the Brazilian economy with more fiscal stimulus. We are indeed in different days. And one small comment that I think Danny mentioned initially was that an offset, there is a temporary offsetting compensating factor at work, which is the reduction in debt servicing. One needn't look blindly only at the debt to GDP ratio, but look at the cost of the debt. And when one does that in Brazil, one feels there has been, despite all the bad news coming out of Brazil, there's been some good news in the incredible reduction in domestic interest rates in real terms from about 5% in 6% in 2017 to just 1% in 2020. So that has created space for some of the fiscal expansion, albeit not for all of it. So that means that we don't need to be prisoners or hostages to a 100% debt to GDP ratio. There are some offsets, but those offsets, those compensating offset lower interest rates that could, we all know, wind up being very temporary. Brazil is an interesting case in the large and most important emerging economies, in that it has, as Guillermo Calvo told us in yesterday's seminar, Jan, it mimics the United States in certain respects in terms of the robustness of its fiscal response, and also the rise in its debt to GDP ratio. Brazil has not been reluctant to spend during this pandemic, and it finished last year in 2020 with an overall public sector deficit. In Brazil, sometimes they focus only on the primary deficit, but I think now Brazil has moved to a more global and globally comparable concept of a public sector deficit of about 14.5% of GDP. So that is an enormous, that is as large as any of the largest of the, most of the largest of the advanced economies. So Brazil has been, but Brazil obviously doesn't have the financial wherewithal, the resources, doesn't start from the base of strength that those advanced economies have. So that's a concern. And a concern for Brazil revolves what the economists are calling now exit circumstances. When this wave of global liquidity and global fiscal spending starts to end and fiscal retrenchment must begin. Nobody sees that happening tomorrow or the next day. Indeed, in the United States, this isn't on the policy agenda yet, but it will be. It is a matter of time when fiscal retrenchment will start. And I think this is going to create problems for Brazil, maybe even before it creates problems for a fiscal retrenchment in the United States and in the more advanced economies. So because Brazil has extended itself fully to the extent the advanced economies, if it starts to retrench, I'm afraid that that retrenchment may have to be more severe than in the advanced economies. So that's a general consideration to offer. The fund, and I think Danny's remarks lead us to believe that what really matters is to avoid some of these horror stories and debt servicing difficulties is a kind of a concept of building back better. Can we manage a sustainable, a credible, what the fund calls a credible fiscal framework coming out of this pandemic? And one can talk optimistically about Green New Deals and digital inclusive economies and managing financial, fiscal and financial financing risks, but those mean one thing for the advanced economies and quite another for countries like Brazil. And what I hear from Ana's remarks is Brazil is kind of inching along, more or less muddling through, and there's not yet the signs, is what I started out my remarks saying, of a credible fiscal package emerging in Brazil. Maybe Ana Carla will correct me, maybe Danny has some ideas, but I think this is the issue, I would say, kind of looking at Brazil from a global perspective, that it's even more vulnerable than the US and the advanced economies, and also more vulnerable than China and some of the advanced emerging economies to any sort of global retrenchment, the rise in interest rates globally, lower liquidity conditions, diminishing of investor appetite and so forth. So the day of reckoning is not upon us. It's not today, tomorrow, next week, next month, but it could be coming in Brazil, and it's going to catch Brazil at a very awkward time politically and then economically. I just wanted to move quickly into one point, maybe to complement what Ana Carla had said about Brazil, and without going beyond my budgeted time here, and that's to talk a little bit about Brazil's war budget. I do think credit where credit is due, but Brazil managed relatively well, surprisingly well, in dealing with the pandemic and supporting vulnerable households last year. This provided a significant stimulus to the Brazilian economy. So we can say today with some sense of relief that the economy only declined 5%. My own forecasts, which are always subject to some uncertainty, had said it's like minus 10% decline in GDP. So it wound up being about -4%, -5%, about the same as in the United States. And Brazil is modestly beginning to grow again. I think Ana told us there's a consensus forecast of something like 3%. The additional fiscal spending in Brazil was large, 8.4% of GDP, again, double the global average. Brazil was not shy. But the one point I would like to say that I would like to highlight, and maybe we can come back to, Ana mentioned it in passing, but I think it has more importance now in Brazilian policy debates and in the future than a mere passing mention would suggest. And that's the social safety network in Brazil, how it was expanded very quickly through this program known in Brazil as Auxílio Emergencial, or Emergency Assistance Program, as well as correlate programs to encourage firms to retain key employees. The special Auxílio Emergencial, emergency assistance package, amounted to 3.1% of GDP. And it was dispersed, technologies, kind of the digital economy at work, right? It was dispersed relatively quickly. There were some glitches in the beginning, and people who didn't deserve to receive the funds did receive them. But for the most part, those funds got relatively quickly to the bank accounts of the people who most needed them. The program is said to have benefited more than 70 million people in Brazil. The population is about 215 million, so almost a third of the Brazilian population. 41% of Brazilian households received that benefit. And this is really what you wouldn't expect to happen in such an unequal country that Ana Carla reminds us of, is that measured poverty and inequality actually decreased as a result of this program in Brazil in 2020. That was sort of amazing given the angst and uncertainty and the suffering that the pandemic has brought to Brazil. No country has suffered as much as Brazil from the pandemic, but at least in that respect, an important addition was made to the toolkit of fiscal policy. Maybe it's not sustainable. Maybe those compensating cuts that Ana has told us are necessary didn't occur, but something did occur in these extraordinary, strange, and frightening times of 2020, the worst was avoided in Brazil. So I think that was sort of the good part. Anna has told us a lot about the more worrisome parts, and I agree with her. That's sort of the good part of the Brazilian stories, that these emergency programs have seen Brazil through a very rough patch. But here's the principal concern, and Anna has alluded to this, and Danny as well. Those emergency support programs, they're on life support. They're likely to be renewed, but at lower levels, and only after a lot of political bargaining and without the compensating tax increases or expenditure cuts in other areas. But their days are numbered for this significant program of help to those who need it most. So that's the good point. The worrying points, Anna and Danny both have mentioned them. Anna mentions very helpfully 2 or 3 years ago, we had this previous version in person of our role at the state conference, and there it's amazing. I went back on and I looked at the record of what Brazil was hoping to do in so many areas: tax reform, privatization, which you didn't mention, tax reform, which you did, administrative reform, which you did, trade reform, again, related to fiscal policy and the fiscal stance. None of that happened. And the dream team that the finance minister put together, the finance team put together to implement all of this, has largely jumped ship or been thrown overboard, to be more direct and go right to the point, replaced in many cases by technocrats without political clout or military officials without a relevant experience in key sectors. Just last week, the highly regarded president of Petrobras was suddenly dismissed for not passing on to the domestic market increases in global diesel and gasoline prices. So he was dismissed and replaced by a military official. So you see, I'm not certain how I would characterize Brazil's fiscal dilemma right now. And I need to wrap up my comments. So maybe just to wrap up, Jan, I think I've said enough about the social safety net, and I think it has to continue as long as this pandemic ravages Brazil, and it continues to do so, more so than in the United States and other developing countries. The safety net has to be maintained, but its days are limited. The fiscal stance is going to be highly constrained during this period of time. It's going to have to hope that the financing is there, but that, as Danny reminds us too, and I've said already, Brazil faces major risks. It's vulnerable at these high levels of debt, of deficits and indebtedness, very vulnerable to even small changes in interest rates or global financial conditions. And already you've seen great concern about the rise in 10-year US Treasury yields and that impact on Brazil. In other words, just like in the mortgage crisis in 2008 and 9, it didn't take much of an increase in interest rates for over-leveraged situations to be revealed. So I worry about that. I think I've made that point very clearly. The final point, Jan, and I apologize, I'm going to, maybe we can go into it in the discussion period, but I did want to get this out there, and that's going back to this issue of a credible fiscal policy. And what have we learned? And what does Brazil tell, what's Brazil's message in that respect to the rest of the world? And the way I would just kind of in a bald-faced way, without really a lot of justification, the fiscal challenge, I think, for Brazil has to be put somewhat differently. That especially coming out of these strange times, these unprecedented times, that the fiscal challenge for Brazil is to strike the right balance between equity, which is fiscal policy that promotes equality and reduces poverty, and efficiency, which is a fiscal policy that promotes growth and private sector and a prosperous and productive private sector. It kind of sounds simple to say that, and Brazil is certainly not alone in not having a fiscal policy that addresses both issues simultaneously of efficiency versus equity. Brazil in recent decades, with some exceptions, with some brief exceptions, maybe in the early 2000s, has either tried to pursue what are called, somewhat disparagingly, neoliberal reforms, which emphasize efficiency, or populist measures, which emphasize equity. but the country has struggled over many years and continues to struggle today with getting that balance right. So what I'm suggesting is now that the fiscal crisis is upon us, these strange times have visited us, we're in uncharted waters. It's time to change the way we think about a credible fiscal policy and package for Brazil, a credible fiscal framework for Brazil. Maybe those 2022 elections are a chance to do it. It's a fiscal policy which pursues both efficiency and equity, maybe keeping parts, for example, of the emergency assistance program while pursuing the administrative reform and others that Ana Carla has suggested. And before you say that's impossible and that's a dream, there are countries that do exactly that. And I would suggest to you maybe the example of the Nordic countries, world leaders in growth, but also world leaders in terms of social protections. And they're not, it's a model among others that I think Brazil, as it seeks to recast its medium-term fiscal framework from 2022 on, needs to look at. So, Jan, I turn it back to you. I hope my remarks here have been clear and that will help us as we move now to the debate period.
Thank you, Tom. Thank you for the insightful remarks and enlarging the set of issues and questions. I would like to invite all the participants who have a question to post it while we are doing the first round of question and answer. Let me add just a few remarks. I think that the panelists have indeed identified all the major issues. And I think that what's very instructive is how different countries have more or less successfully dealt with the pandemic. That we have after the first year, and unfortunately it's not over, as Ana Carla mentioned, there is a second wave, in some countries already a third wave, and even though the vaccination is proceeding faster somewhere, in some countries slower others, there is still an issue of how the fiscal policy should proceed. And I think that both the advanced and the developing countries have indeed had a variety of experiences. One aspect is how you help with the fiscal policy the poor, the bottom couple deciles, 3 deciles, and indeed there were direct measures, and Brazil was mentioned as a very good example where this issue of equity has in fact been, at least in the first phase, handled well. There are countries that have done it this way, plus trying to provide help to firms, to enterprises, small, medium, but even large ones, to delay layoffs, to delay dismissal of employees, and therefore keep the link, the attachment of the firm and the workers, so that in continuation, it wouldn't be that difficult for the firm to really continue, and also to prevent a major wave of bankruptcies. So the countries that have done well have prevented huge wave of bankruptcies by temporary fiscal measures. And here again, the interesting question is how to do it. And those that were more successful have, for instance, realized that while it's impossible in the shock of the pandemic to quickly provide liquidity to firms that were illiquid, not insolvent, but illiquid, learned that what they could do is to stop withholding taxes and social security contributions. So they left the liquidity in the firms that otherwise would be siphoned off. And that was the fastest way to help the enterprises, to help the firms. Okay, those who didn't do it faced much greater wave of bankruptcies, right? So I think that's one point at the micro level where the fiscal approach made a lot of difference across countries. And I think that unfortunately, given that the second wave is coming in many, many countries, those lessons could be transferred, lessons like this and others could be transferred. So there is some learning that can be done cross-nationally and across individual experiences. I think that the second point that was mentioned, and I'd like to sort of panelists to agree on it, is this issue of low interest rates. Indeed, this is a very fortunate aspect. People who have studied it claim that you have to go way back in history to Babylonia to find the interest rates that are zero or even negative, as they are in Europe, for instance, in Germany and some other countries, so that provides a temporary valve of relief. And it is the case of lower income countries, but also countries like Italy, which were in severe fiscal problems that temporarily have huge relief by being able to borrow at very low interest rates. And here, as Tom has already mentioned, I think we should consider a little bit more the issue of what happens when, in fact, interest rates start rising and inflation starts rising. Our discussion yesterday in the monetary panel was that the people agreed that they expect the impact on the emerging market economies to be very strong, stronger than in the advanced economies themselves, that the effect will be felt, in a large way, and that in fact the retrenchment may come faster in countries that do a lot of vaccination, like the US, where they will be able to afford, in fact, to transit from the huge expansionary fiscal arena, which will, obviously happen right now. But later on, the Federal Reserve Bank is likely to stop increasing its assets and indeed go back. So the effect then, the question is, what is going to be the effect on the advanced economies, and what's going to be the effect on the emerging market economies? So I think that's something that the participants should maybe still address. We have also, maybe let's start with this round, let's go back to that, see if we think that indeed there is going to be an asymmetric effect and that the emerging market economies are going to in fact feel a much greater shock from the change in the monetary and with it then the fiscal policies in advanced economies such as the US and of course ECB and Europe as well, Bank of Japan and so on. So you should also take the advantage of the first round to respond to each other, react to each other. Danny, would you like to start?
Sure, thank you. I think on the last point about changing interest rates and the effect on emerging markets, we only have to go back to 2010, 2012, and Minister Montega being unhappy with the Fed because lower interest rates were causing the real to appreciate. Now it would be the opposite, right? Interest rates would go up and capital would perhaps come back to the U.S. I think it's a fair assumption that we're going to see a new round of emerging market debt distress. I think there was a bulge in repayments 2021, 2023 anyway, plus countries have borrowed more in 2020, and the interest rates can only go in one direction, right? They're not going to get any lower. So I think that means that the international community needs to come up with some new ways to preemptively deal with debt distress, right? I mean, going through an Argentina, Zambia kind of thing is not healthy. And I think we need to view it also as an opportunity to bring China into the rescheduling game. They prefer to do it one at a time. And their banks lending is somewhat opaque. And so I think there's been some discussion about this, but I think we need a new round of figuring out how to do debt relief. The last couple of rounds had to do with low income countries. This is a middle income developing country problem. The only example we had were the Brady bonds in the late 80s and early 90s. And I don't know if the US can exercise that kind of leadership, but it can't do it without China being inside the tent. So I think that's on the interest rate side. I'm going to skip the inflation issue in the US because I think it's a little bit peripheral to what we're talking about. I would refer people to a nice graph in The Economist magazine a few months back that showed what we know as the Phillips curve, and it seemed pretty flat. Now, largely, I think it's because we don't measure unemployment correctly. Jan, you're the labor guru. You know that what we say, the unemployment rate is 3 or 4. That's not really right. It excludes a lot of different categories of workers. And inflation also has its own construct. So yes, we might see a bit of a rise in inflation, but certainly we're nowhere near the 2%. I think on the Brazil story, I think Ana Carla presented a lot of fantastically useful information. The only thing I would say on civil service reform is that, it might be useful to also consider things that the public sector is delivering that the public sector shouldn't be doing. We can target services and we can provide subsidies for services, but we don't have to deliver them through the public sector. And I think the size of the public sector clearly is a problem because for the reasons you said, which is it's low productivity in many areas. I think the challenge of Brazil is that yes, as Tom pointed out, there have been a lot of good transfers to the lower income part of the income distribution. So much of these reforms are going to affect the lower middle class and the middle class. And I think politically that may be more complicated to put into place. But I think the fiscal situation is not good and it's not going to get better, right? It's not going to get better because interest rates will rise. It's not going to get better because the piecemeal reforms that perhaps this presidency in Brazil can put forward are not going to solve the problem. We saw that the problems are too large to go with this sort of muddling through piecemeal reform. Not to say that it shouldn't be done, but it's certainly not going to solve the problem. And the big issue, coming back to economic growth, is that as this debt burden becomes larger, it's going to crowd out more lending to the private sector. And that's been perennially the difficulty in Brazil. And you, Ana Carla, did work on the spreads in Brazil and why they were so large. And we might expect to see them get bigger again, right? Because if the government's going to be borrowing a lot and it's a risk-free investment, why would I want to lend to the private sector when I can get 10% on government paper? So I think the main issue is that, as usual, the diagnostics are pretty clear. The political economy is the constraint, and the half-hearted approach to reforms, I think, will be problematic for Brazil's future. I'll stop here.
Thank you, Danny. I think that you've mentioned a number of important points. The one that I think is I'd like to stress in the context of the overall discussion is that yes, there will be an increase in interest rates as interest rates rise in the advanced economies, the US in particular, but also if the impact on the emerging markets, countries like Brazil, will be very strong. And what will happen is that the risk premium that the investors will demand may rise as well. And so in that sense, the interest rates may rise even more for countries such as Brazil, because the uncertainty and risk connected with it will rise as well. And here I'd like to point out one thing that seems to be a pattern right now that we observe across countries, and that is that when uncertainty is very high, as it is now, public and private investment are very complementary. In other words, an increase in public investment increases the private investment and vice versa. So if public, in other words, in low uncertainty, there is displacement. So very often public investment is a displacement for private investment. But in uncertainty, the private investors are looking for a clue, is the public sector able to lead the investment drive? And if not, then they are reluctant as well. And so here, that aspect is going to be very important. Ana Carla, would you like to respond?
Thanks, Well, let me just pick up some points that both Tom and Danny mentioned, and also you, Jan, that I think they're very important. First of all, the impact on emerging countries, and specifically in Brazil. Actually, we've been already impacted even before we have the interest rates going up globally, because Brazil is not benefiting from the liquidity, the global liquidity that comes along with all these stimulus that we have been seeing during the last year. for investment is not happening. Actually, the other way around, we've been losing for investments recently, not only recently, but actually the point is uncertainty is so big that we are not benefiting at all from the global liquidity that is, of course, flying to other emerging countries. So not only we are not benefiting, but also we have been hit in terms of the foreign exchange market much more harder than the other emerging countries. Then he mentioned that point, but Brazil, the currency, our currency devaluated 30% last year, which is much more than our peers and other emerging countries. So we are already in a very bad situation. And I agree that once we have interest rates going up, and they will go up globally and also in Brazil because we have inflation pressures already. Everything that we were able to build along 2018 and the beginning of 2019 will disappear because, of course, the fiscal relief we had with our interest rates going down, the liquidity and investments that we were able to attract with interest rates going down globally, this will all disappear. And that's why, and also because of all the points that Tom mentioned, that it's really difficult to be optimistic about Brazil. We are under a very, very difficult situation. And even the point that was mentioned, Dennis said there's a good part of it. There are some positive points like the stimulus, like the emergency support that we were able to deliver very fast. The point is that Brazil is very good on spending fast, not necessarily well. So we spent a lot. It was not focused. It didn't reach everybody that needed, and it reached a lot of people that didn't need the money. So, and now we are trying to put in place an emergency support that is 1/10 of the volume of money that we delivered last year. So it's really hard to see Brazil improving along the rules and the orientation, the political orientation, the economic orientation that we have nowadays. And just one last point that I wanted to mention, and Tom talked about this, is that yes, we did have a dream team that was formed by Minister Paulo Guedes when he took office. But once you don't see the president supporting those policies, they formulated a lot of good things on digitalization, on privatization. We have very good people in the government, both the ones that came together with Guedes, and also people that are civil servants that are very good, and they are very good in formulating. But once you don't have the support from the president and from the political supporters of the president, it's really hard to keep insisting in a good agenda. And that's where we are currently. And that's why it's so difficult to look, to observe those 2 years ahead of us and be optimistic about Brazil. We will, in the best of my guess, yes, we will maybe muddle through. That's optimistic. If we muddle through, it's good. It's good news. So I really think that the turning point will come in 2022, hopefully, because of course re-election is on the table. And let's hope the turning point doesn't come before to the wrong side of the equation, because politically we can't just ignore that the tension is there. So we need to be careful, and we need to be able to to avoid a turning point that it's bad to democracy, it's bad politically, it's bad to Brazil as a whole.
Okay, thank you, Ana Carla. Yeah, those are really sobering remarks indeed. As interest rates will rise, government spending may not be as strong, cannot afford to be as strong, and FDI may not be the panacea. Then indeed the targeting, or what Danny called the greater efficiency of public spending and public investment, will be crucial. I'll turn it to Tom, but there are two questions that I will mention that you can think about it. For Ana Carla, the question that one of the participants is mentioning is military, the government spending that you're talking about, et cetera, and the reform. Is it to include also the military, or is that, for whatever reasons you may think, sort of not going to be touched or cannot be included in the reforms that will be? And for Tom, a little bit more lighthearted, but with an undertone in it, is it time to sell your apartment in Sao Paulo? In the meantime, let me turn to Tom and see if you have something that you'd like to add as a result of this first round.
I don't want to answer for Danny, but it might not be time right now. It might be too late. Danny could answer his question about his apartment there.
Oh,
but
please keep the apartment.
The apartment, right.
I think you should keep it.
Is it an economic judgment or solidarity?
It's a nice country. People are nice.
I do think that's a segue, Jan, just a quick comment to say we don't, I think that the scenario that Ana has described, I agree with it. It isn't necessarily disaster either. And that's not what we're predicting. It's just vast underperformance, Jan, in Brazil, compared to where Brazil could have been and should have been by now. There's been decades of reform, pension reform, foremost among them, and some things have been done, but never quite enough. And then always subject to political bargaining and watering down of packages. And that's exactly what Ana has just told us is happening to the three reforms that are presently wending their way through Congress. So something will come out of them, and maybe it'll be an advance, but it isn't likely to be very significant. But I would say and I have a question for Ana to consider. I do think there are some offsets. I mean, there are some compensating factors. Brazil's size, the size of Brazil's domestic market. Most of the debt now in Brazil is issued in domestic currency. So one can presumably that it's not foreign debt is not a major problem. The international reserves are quite large. The management of the central bank has been quite clear-eyed, I think, throughout this whole crisis. And last week, the autonomy of the central bank was reaffirmed. So there are some positive signs. One sign that I thought might be more positive, Jan, let me mention 2 points here. One point is the depreciation of the exchange rate. I think Ana mentioned something like a 30% decline in the real dollar rate. And sometimes that can act to stimulate the economy. It sort of is a cushion, that floating exchange rate. But it doesn't seem to be playing that role, does it? Does it, Ana? Maybe you can talk about that, and that may be due to Brazil's low participation in global value chains or whatever, or lack of trade agreements. But ordinarily one would think while it's never good that your exchange rate is depreciating 30%, it shows a lack of confidence by investors, foreign and domestic. You would look for some kind of an impact in the real economy, and I don't know whether we're seeing that or not. That's one. The second is to build back better in Brazil.
Here, Tom, interject. It has the competitive effect, which is very good. But it also can have the inflationary effect, right? Through imported goods being much more.
Yeah. That's correct. That's correct. And I just finished with the point I've made already, John, but I just maybe want to keep it in the debate. And that is the equity measures that you mentioned that we talked about, that Ana has addressed recently. In particular, given all the problems of targeting, I grant you that, but it showed us, it got Brazil through this pandemic, and that was a major accomplishment in Brazil. And the question I'm trying to pose is, shouldn't some sort of income support be a part of the fiscal policy arsenal going forward? And I know we have a lot of reforms to do, but it seems to me that's a critically important equity issue, and it would build political support, having minimum income supports in Brazil of some form. and it's being discussed now in Brazil quite openly, would increase support for things like privatization, for civil service reform, for pension reform, all of which take away, right, from what the population perceives to be, that it's receiving the public sector. So I do think that it's part of my broader pitch this morning to, as we look into 2022, to that credible fiscal framework, that the equity issues be front and center alongside efficiency issues. I think the balance has got a little bit out of whack in recent years and needs to be restored.
Very good. I would then pass it now to Ana Carla. If I can ask part of our team, maybe Isabel or somebody on the Brazilian language side, there is one question in Portuguese, which I admit
Okay.
I don't have. So if you can maybe prepare a quick English translation for it while Ana Carla is addressing the issue of government spending and the military sector in it. And then Danny, of course, his apartment. That's important.
Okay, let me start with the military question, the inclusion of the military in the reform. So first of all, thanks, George, for your question. Actually, it should, as it should be included in the pension reform back then. The point is that with this government, with this president, they won't be included. Actually, it's the other way, it's the contrary, because now what we see is that the military, they have been promoted, they have been having increases in their salaries, and they have a huge increase in the defense budget. They were able to have all their claims fulfilled even during the pandemic, and this is the same for military in the states. So it's an issue that we will have to face, but it won't happen in this government. I'm sure this is maybe the main political support base of the president. So, but we will have to face this. The points that Tom mentioned, first of all, yes, Tom, we are big. Brazil is a big market, but we are getting poorer. So it's a big, poor market. It's a big, poor market that is getting even poorer, more poor. So it's hard. It's hard to rely in a market that is getting poorer, and that's the point. So of course we want to, and our domestic debt is it's mainly, our debt is mainly domestic. So I don't see a big risk of default. We are not going to Brazil is not getting into a very big trouble. We are not facing bankruptcy, but we will get poor, poor, and poorer. And worse than this, we will keep this path of inequality, and especially the majority of the population in a very bad situation. The point of the foreign exchange rate. The main problem is that we didn't have the trade reform that was part of the agenda 2 years ago. So it's a closed economy. We don't benefit from, fully benefit from the positive points of a devaluation. We just keep the inflation impact. We mainly keep the inflation impact that is hitting now. And of course, we have this impact rather than the benefits, and this negative impact rather than the benefits. The social security point, and you know that's a very hit debate here in Brazil currently, because people say you can't talk about reforms now. Let's just make the social security stronger because people are dying, are starving. And what I say is that one thing is the emergency, the importance, the relevance of extending the emergency support and strengthening our social security network. But we can't just forget that we have to signal that all this imbalance will be, this fiscal imbalance will be faced and solved in the future. We are not saying, no, we have to cut now to open room in the same time, same volume of the social security, the emergency support. But we have to signal that we are going to pursue a more balanced fiscal situation. And that's why I think it's a very emotional debate when we say, no, the fiscalists, they don't want to support the people that are starving. They just want to cut spending. They just want reforms that will hit those people more and more. And those are two those debates. They can be in parallel. They can move on in parallel because we need to face our problems. They didn't disappear just because of the pandemic. Actually, they elevate because of the pandemic. And if we don't face them now, we are going to pay the costs in the near future. Actually, this year, next year, and for generations. So let's just make sure we are able to do the two to cross the two roads and to pursue the solutions for the two problems.
Those are very important points. So let me bring in that additional comment as Danny and Tom weigh in the last round here. The point that has been made, and it's an important one by one of the participants, is that most of the debt, certainly since 2010, has been accumulated as an internal debt, okay? And that has traditionally in the world meant a different thing than foreign debt. Like the Japanese have huge indebtedness, but it's mostly domestic debt. And the financial markets never considered that to be a problem. It's inside the family, and so inside, the rest of the world doesn't have to worry about it, right? Is Brazil similarly shielded in some sense as the Japanese have been? Or is the situation different? And in some sense, as debt grows beyond certain limit, is the family gonna quarrel? Is there gonna be internal upheavals of any kind? And is the internal debt, in fact, a problem as well, although different from an international debt? But so let me go back to Danny and Tom, and you can work this in if you want.
Thank you, Jan. I think that's a very good question. My answer would be Brazil does not want to be like Japan. The fact that the debt is huge and internally held is a byproduct of 20 years of recession, bad demographics, and a pretty poor outlook, right, in terms of what's going on. So, yeah, it's less dramatic than having an Argentina external debt default. Brazil, has managed to avoid in the last 20 years these big problems, but it's a more insidious kind of problem. It's what Ana Carla is referring to in her very sobering assessment, which is that we see, I think, inequality being reinforced. Also, by the way, the pandemic has been handled in Brazil. I think it's reinforced inequality. I think Tom has spoken about the inefficiency issue. I hear what you're saying, Tom, about some sort of a quid pro quo between providing assurances in terms of income support, etc. But I think, as Ana Carla said, Brazil is good at spending and it can do it quickly. It may be less good at targeting, and it's certainly not good at getting out of things. Subsidies that are inefficient and that are draining the economy and making it less efficient shouldn't exist. When I go on the metro in Sao Paulo, just because I'm above a certain age, I shouldn't ride for free. I have the income to pay, right? A lot of things that are below the surface, but there are also plenty of things that are above the surface in terms of expenditure patterns that are not good. And I think Ana Carla was absolutely on point on the why the depreciation hasn't benefited Brazil. But if you look at a World Bank report from 1980, 90, 2000 to 2010, you're going to find the same issues about the Costa Brasileiro and red tape and all sorts of inefficiencies that Brazil has managed to avoid dealing with. And I come back to the muddling through comment, which you and I, Ana Carla, probably agree with, which is the muddling through might be the best option. However, when you muddle through, there's no political support for major reforms, right? The glass is seemingly half full. I view it like you do, that the glass is getting less and less and less full, but it's happening gradually. So you don't have a crisis, in which case, major reforms are undertaken, but you have a slow deterioration of the situation. And I think any reasonable projection shows that the situation is, as you said, will get worse before it gets better.
Thank you, Danny. Tom, do you have any last words?
Appreciate that last and Chris. I do think yes to the question about the not having the foreign exchange debt. I kind of was introduced to Brazil through its foreign exchange crisis in the 1980s, and yes, this is very different. But it's like Danny said. I think I used the word insidious because lots of bad things can still happen, even though the debt is issued locally and held locally. The yield curve, for example, gets out of whack, and the debt tends to be issued on shorter and shorter maturities overnight in some cases, which that long yield curve that Brazil developed painfully over many years, which gives a certain stability to roll and reduces rollover risk. Rollover risk becomes a major issue as investors wait to see what the rate on the next issuance of paper is going to be. The exchange rate deteriorates under uncertainty about interest rates and inflation domestically. Financial stability becomes a concern. People who guess the wrong way in the direction of the bond markets. There's been quite a bit of asset inflation in Brazil in terms of the stock market, reaching highs in recent months, despite all the problems we've all talked about there. That's a form of inflation which can readily become deflation of those assets, causing a great deal of corporate stress. So yes, there's some comfort in my mind in this not being a classic foreign exchange crisis, but that doesn't mean, and I think Danny said it better, this doesn't mean that this is certainly not the way to go. You've got to manage the public sector debt for fiscal stability in the long term, and we're not on, as all of us have said, we're not on that path right now.
All right. Well, unless somebody has still a burning point to make, I think it's the witching hour in the sense that it's time to thank you, panelists. This was a terrific tour de force performance. Thank you all the participants, including those who have posed the questions. They were right on target. And we'll see you during one of our next panel discussions, roundtables. And thank you very much for being here.
Thank you, Jan.
Thank you.
Thank you.
Thank you, Jan. Thank you,
Pleasure.
fellow panelists.
Good to be with you all. Thank you very, very much.
Hasta luego.
Bom dia. Nice. Ciao.
Very good. Ciao.